This year, a retired couple is going to cross an invisible line by one single dollar. And that $1 is going to cost them thousands. One quick note before we start. This channel is education, not advice. Always check your own numbers with a professional. These invisible lines have a name. They're called tax cliffs. And almost nobody sees them coming because nobody puts up a warning sign. Today, I'm going to walk you right up to the edge of 5 of them, one at a time. And number 4, that one was gone for 5 years. It quietly came back to life in 2026, and most retirees have no idea. Welcome back to Uncle Ray's Retirement Desk. I'm Ray, and I'm really glad you pulled up a chair. Now, here's the difference that makes a cliff so dangerous. A normal tax bracket is gentle. Only the dollars above the line get taxed at the higher rate. A cliff is not gentle. Cross the line by a single dollar, and the penalty can land on everything at once. To keep this out of the textbook and in the real world, we'll follow our usual couple, Frank and Carol Carter, as they walk up to each edge. And we'll watch exactly what happens. 5 cliffs. Let's start with the one that quietly catches more retirees than any of the others. Number 1, the Medicare surcharge. You may have heard it called IRMAA. Once you're on Medicare, your Part B and Part D premiums start out the same for almost everyone. In 2026, the standard Part B premium is $202.90 a month. But climb above a certain income and a surcharge gets bolted right on top. For 2026, that first threshold is $109,000 for a single filer and $218,000 for a married couple. Now, here's the cruel part, and it's what makes this a true cliff. Go $1 over the line, and the full surcharge kicks in. Not a little, the whole thing. Say Frank and Carol do a large Roth conversion one year, and it pushes their income to $218,001. That single extra dollar can add well over $1,000 a year to their Medicare premiums, and that's for each of them. But here's what really makes IRMAA silent. It looks back 2 years. Your 2026 premium is based on your income from 2024. So the bill arrives long after the decision that caused it, when you've completely forgotten about it. If you're planning Roth conversions, and we did a whole video on those, this 2-year delay is exactly why the timing matters so much. Number 2, the Social Security tax torpedo. A lot of people are surprised to learn their Social Security can be taxed at all. How much gets taxed depends on a figure called provisional income. Think of it as your other income plus half of your Social Security benefits. For a married couple, once that number climbs past $32,000, up to half of your benefits can become taxable. Push past $44,000, and up to 85% of them can be taxed. Now, watch the edge closely, because this is where it earns the name Torpedo. When Frank and Carol take just $1 extra out of their IRA, that dollar doesn't only get taxed on its own. It can also drag more of their Social Security into the taxable column right alongside it. The result is a strange kind of math. A dollar that looks like it sits in the 12% bracket can actually be taxed at 40% or more once the torpedo fires. And here's the quiet part. These thresholds were written decades ago, and they were never set up to rise with inflation. So every single year, they pull in a few more middle-income retirees who were never the target in the first place. Number 3, the 0% capital gains cliff. And this one is a little different because it's actually a hidden gift that's very easy to fumble. In 2026, A married couple can have taxable income all the way up to $98,900 and pay zero federal tax on their long-term capital gains. Not a low rate, zero. But here's the trap that catches people. Your capital gains stack on top of your other income when you figure out which rate applies. So picture Frank and Carol sitting comfortably just under that line, and then they sell some stock they've held for years. The gain itself lifts their income, and every dollar of gain that pokes above 98,900 flips from 0% straight to 15%. A couple who could have taken their profit completely tax-free ends up handing over 15 cents on every dollar that spilled past the line. The lesson here isn't to be afraid of selling. It's the opposite. Know exactly where that ceiling sits before you push the button. In a low-income year, that 0% room is one of the most powerful and most overlooked tools in the entire tax code. Number 4, and this is the one I promised you, the cliff that just came roaring back, the health insurance subsidy cliff. Here's the setup. If you retire before 65, you're too young for Medicare. So a lot of early retirees buy their coverage on the ACA marketplace, and they lean on a premium subsidy to make it affordable. For 5 years, from 2021 through 2025, that subsidy faded out gently as your income rose. But on January 1st, 2026, the old hard cliff came back. And it bites harder than almost anything else on this list. If your income crosses 400% of the poverty line, that's about $84,600 for a 2-person household. Your subsidy doesn't shrink a little. It disappears entirely. So imagine Frank and Carol, both retired early, sitting right at that line. One extra IRA withdrawal, one capital gain, and they're over. To put real numbers on it, a 60-year-old sitting just under the line might pay around $500 a month for coverage. Step just over it, and that same plan can jump to over $1,200 a month. Thousands of dollars a year wiped out by a few $100s of income. If you're anywhere in that early retirement window, this is the cliff to watch the very closest in 2026. Number 5, the widow's penalty. And this one is quieter and harder than all the rest because it arrives hand in hand with grief. While both spouses are alive, they file their taxes jointly. They get the bigger standard deduction, $32,200 in 2026, and they get wider, more forgiving tax brackets. But after one spouse passes away, the survivor eventually has to file as a single person, and almost overnight the standard deduction drops to $16,100. The brackets shrink by roughly half. So picture Carol living on nearly the same income she and Frank had together. She can suddenly owe noticeably more tax on that income. And worse, that squeeze can shove her right across the other cliffs we already talked about, the Medicare surcharge and the Social Security torpedo. It's a tax cliff hiding inside a loss at the worst possible moment. It matters so much that we made an entire video devoted to just this one. So look for that if it touches your family. So step back with me for a second, because once you see the pattern, you can't unsee it. Every single one of these 5 cliffs punishes the exact same thing, crossing a line you didn't know was there. And here's the hopeful part. Lines can be found. Income can often be shaped. The year you convert, the year you sell, the year you take a withdrawal. You have more control over which side of the edge you land on than it feels like. That's really the whole game. Know where the edges are, and then choose on purpose when you walk toward them. If this made even one of these cliffs clearer, do me a favor and subscribe so the next one finds you. We take it one topic at a time in plain English, always checked against the IRS. Frank and Carol will be waiting for you at the next desk. And one last time, because it matters. This channel is education, not advice. Every situation is different, so take these ideas to a qualified professional before you act on any of them. Thanks for spending your time here at the desk. I'll see you next Friday.